Welcome to the Money and Wealth Show. Brought to you this week by AmericanManganeseInc.com. This week's host is Victor Adair.
Well, welcome. We're here today with Adrian Mastracci. Adrian is a portfolio manager with KCM Wealth Management in Vancouver. Adrian and I have known each other for a number of years. And just to set the stage here, I want to tell you, we're taping this on October the 4th. And the reason I say that, there has been so much short-term volatility in the market. For all I know, this market may be up or down 10,000 points by the time we get around to actually having this where you can see it. So in fairness to Adrian and myself, that's the story. So Adrian, let's get right into it. The stock market, the Toronto stock market, the broad average has fallen in excess of 20% so far this year. I think a lot of people that are watching this show that have got money invested in the market are either worried sick, in despair, angry, in denial, any number of things. I've asked you to come on the show with us here today to get your perspective, to get your view, what you tell your clients, how they should be looking at the market, what you tell your clients they should be planning to do, and what sort of expectations they should have. So there's a range of things to start with, but let's just deal with the first thing. Market's down hard. What are you telling your clients these days?
One of the things to expect is much more volatility than we've had so far. Mm-hmm. I think that this is going to go roughly in the same direction for a while, which is downward. I think there's a big wall of worry out there in many people's minds. I think there's a lot of pessimism. Somehow, though, after all that is said and done, you have to find the roadmap that you like, the roadmap that fits you, the things that you can do with your portfolio so that whenever the portfolio is supposed to deliver for you, it hopefully can. Mm-hmm. So these are the sort of things you really have to start with. In other words, come up with, where am I going? What am I supposed to be doing? What should I do to my portfolio so that I can navigate the pessimism, the wall of worry, the fears, the volatility?
And that would be great. Like if we'd all done that, right? But I think a lot of the folks that are watching the show today, didn't really have that plan. Now they got themselves in maybe a bit of a pickle here as to just what to do. And there's no point in us saying, well, we told you so, So for the folks that maybe find themselves in this spot, markets are down, they really haven't had a well thought out plan. My easiest bit of advice personally is to say, I know the market's down. The last thing you want to do is sell, because just as soon as you sell, the market's going to go back up. But that's not the way to look at it. If it's keeping you awake at night, you need to sell some of your positions, get it down to the point where you're comfortable. And the reason to do that, I think, is to clear your mind. Wouldn't you agree?
I certainly agree. And I think one of the key things with a lot of investors, and you're right about the plan, they don't have a plan. And I don't think they have to sell everything they got, or they don't have to make major adjustments, but I think they have to get a plan that includes an asset mix. Mm-hmm. How much do I have in equities? How much do I have in fixed income, real estate, anything else that suits me? Once you have that, then you populate your investments to that. So if you happen to be the lucky guy and have a lot of cash, maybe you can stand a little more in the equity side. If you're like most people and you've got too many equities, too many stocks, too many mutual funds, you may have to prune some of those back. So these are the sort of things you have to start with, because the big question is, do I want my money to come back to me sane and whole, or do I need a growth pattern on my money? And those are two different portfolios. Mm-hmm.
Now that's a good point Adrian is making, is to try to figure out what your objectives are. And you're identifying two broad objectives. One, maybe you've got a nest egg pulled together and you really don't need to stress that and don't need to put too much risk on it. You just want to generate a little income from that, but overall you want to hang on to your dough. The other person wants to be a little more aggressive, or maybe needs to be a little more aggressive and get some growth out of that portfolio. And before we started to tape the show, Adrian, you were telling me that when somebody comes to you, you actually have a list of 36 questions you put people through to identify which of those broad camps that they fall into.
Well, that's right. We want to know what kind of an investor they are. Are they aggressive? Are they capital preservationist? Mm-hmm. Can they stand, half and half? Just what is it that suits them? And I think one of the things to do is to look at the kind of person that you are, look at the kind of investments that suit you, and then just say to yourself, here's the path that I have to navigate. If I'm okay with the risk, I'm okay with the path, I'll do it over time. And one of the things that investors should understand, they don't have to invest all their money if they happen to have cash, let's say. They don't have to invest all their money in the equities all at once. You can do it over a year or two. Take your nest egg divided by 5, 6, or whatever suits you, and just take 10%, 20% every so often, every 2 or 3 months. Put it in the market if that suits you. So you don't have to do everything all at once.
I think that's a very important, a very important point Adrian is making. It's not all or none all the time. You know, you ease in, you ease out. That sort of thing is what you're saying.
Exactly. I think if things feel okay to you, if you can stand the risk, ease into things. If things don't feel good to you, too much risk, ease out gently. That's probably the best way to look at the portfolio. Then you're not making those big changes that all of a sudden change your portfolio in a big way. Those are the kinds of things you probably shouldn't do. Those are the kinds of things you're probably going to make mistakes at.
Key takeaway here, and when we come back, by the way, we'll talk to Adrian about what he's telling his clients to be doing now. But I think the key takeaway before we take the break is it's not always, it's not hardly ever an all or none situation, and it's much easier to ease in and ease out of the market if you've made a plan ahead of time.
Exactly, and I think the plan is really the key thing. It's like building your house.
Yeah.
Would you build a house without a blueprint? Hopefully not. I can't find anybody.
I wouldn't want to live in a house like that.
No, I wouldn't either. I haven't found anybody yet that builds a house without a blueprint. But there are many, many thousands of investors who have built a lot of investing portfolios without any blueprint whatsoever. And it's never too late to tweak or start that.
We'll be right back after this break.
Always consult your investment professional before making any investment decision. You're watching The Money and Wealth Show.
American Manganese, Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese. American Manganese, Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
The Money and Wealth Show is archived online at TalkDigitalNetwork.com. Here's Victor Adair.
Well, we're back, and we're talking with Adrian Mastracci, a portfolio manager with KCM Wealth Management in Vancouver. Adrian, in the first segment here, we were talking about facing up the reality. The market's come down a lot. People are worried, they're concerned. Maybe some folks even in denial, hoping that things will get better. You were making the case that with your clients, you make a plan as to how to be involved in the market, that you're never all in or all out on any one decision. You kind of work your way in, work your way out, that sort of thing. You also made the point that you've got broadly two different kinds of clients that you advise. People that have gathered a nest egg and are essentially wanting to hang on to it, and people who maybe haven't quite got to that stage and they want to grow their portfolio a little more. We said that you have 36 questions that you give those clients to help them identify who they really are. They may not be the person that they think they are. Okay, having said all that, what we want to ask you now is, how have you got your clients, and given there's broadly two different kinds of them, how have you got them positioned in the market now, and how do you anticipate that you may be changing their portfolios given what you think is happening in the market?
Let's talk about the capital preservationist type first.
Okay.
The one that can't stand as much risk as the other person. That person might have 80% cash, 75 or 70, something like that.
His portfolio could be as much as 80% in cash right now.
Could be in a lot of cash,
okay,
because they can't stand the risk of of investing in equities. It doesn't matter what the reason is. If they can't stand to be in the markets, then they shouldn't be in the markets until they feel comfortable. Somebody like that may in a good normal market, which we haven't had in quite a while.
Yeah,
whatever that means anymore. In a normal market, they may have 30, maybe 40% total in equities, if that was a normal market. So somewhere between now and whenever that new market comes along, we'll migrate from, let's say, 70 to 80% cash, all the way down to maybe 60% cash or so, and the rest being in equities. So that's the first type. The other type who says to me, Adrian, I can stand to have some growth in my portfolio. That person might have 60, 65% in equities in a normal market. He or she is probably 40, 50% now, something like that. So we're looking to sort of gradually get in and parlay the money into a bit more of the equities so that over time I'm near his normal profile. So the profile is very key. Once you identify the profile, the idea is to stay invested within that profile.
So the market's going to have ups and downs, and hopefully, I'm sure, you're running a business, and some people are going to get upset when they're losing money, even if they're losing a little bit of money. But you hopefully you set things up well enough in the first place to tell people, markets are going to go up and going to go down, and we're going to adjust your portfolio. But for the person, let's say, that thought he was interested in growth, and maybe he's got 40 to 50% of his portfolio in equities now, and let's just say it's in a broad basket of Canadian stocks. I'm being presumptuous, but let's just say that. And he's going to be down a little bit. So he phones you up and he says, well, Adrian, what do you think? How do you talk to that person right now?
One of the things we always do is suggest to them before they get invested in the markets that they're not always going to make money. You may not hear that from many portfolio managers, but I can tell you that, and you certainly know as well as I do, you don't always make money in the markets. So there are periods where nothing works. You can have the best stock, you can have all the things you want in your portfolio, but it just doesn't work. This is one of those areas. This is one of those times when it seems that every time you make a new investment, it keeps going down a bit. So you have to look at it and say to yourself, it is very possible that I will be investing in the markets and I will have less value at the end of the day than I do at the beginning of the day. And it just keeps on going. So you know that this will happen. You know that you have to parlay your investments over a period of time. And that's why we tell all of our clients, you've got to be in this for the long term. Long term to me means at least 5 years, 7 to 10 years preferably, so that if you cannot be in the markets for that length of time, in other words, you're not going to go dip in there, sell something because you need it. If you can say that to yourself, then you have enough time to look at a long-term market, shape the portfolio the way you want it, make sure that you're pursuing the things that you want, because clearly I can't change the market. I can't affect the markets, neither can the investor. But we can affect how much you have in equities, how much you have in fixed income, how much risk you take, how diversified you are. All those things are very key to a portfolio. So that's what a client has to understand first. And every now and then when we incur losses, and we do every so often, we may have to sell some of them.
It sounds to me that for both your investor types, the guy who's just trying to hang on to what he saved and the fellow that's trying to grow the money he's got on deposit with you, that for both of those types, you're pretty defensive right now. You realize we're in a bear market, and you're not saying, God, this is the buying opportunity of a lifetime, certainly.
Well, what we're telling our clients is that it could be a buying opportunity, but you have to have the stomach to go in there over a number of times, as I said, maybe 5, 6, 7, 10 times, whatever suits you, and just parlay your money into the market slowly. But you have to have the stomach to be able to say to yourself, maybe this is not the bottom, and it likely is not. And I will be buying, as an average, between now and let's say a year or two from now, over time, so that I will have a pretty good average of my cost for the equities and stuff that I buy. But at the same time, I have to have enough of a stomach to be able to say, things could go down, and I'm okay with that.
We're talking with Adrian Mastracci. We're going to take a break and come back. And when we come back after the break, I want to talk to Adrian particularly about, in this environment, market's been falling not exactly like a stone, but awfully close to like a stone. People are worried, people are concerned, and you have to be formulating a plan as to maybe you're going to actually start to buy some stocks at some point here in the future. So we want to talk to Adrian about what would be the sort of things that he'd be looking for that would cause him to step up and put some more money into the market. We'll be right back after this quick break.
You're watching The Money and Wealth Show.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com. Or phone me, Larry Ray, at 604-531-9639.
The Money and Wealth Show is archived online at talkdigitalnetwork.com. Here's Victor Adair.
Well, welcome. We're talking with Adrian Mastracci. He's a portfolio manager at KCM Wealth Management in Vancouver. Before we took the break, Adrian, I think, made it very clear to us that for the two broad kinds of clients that he has, the person that's trying to hang on to the wealth that they've accumulated and the person that's trying to grow the wealth that they have with him in their portfolio, for both of those kinds of clients, he's been more defensive than he would be, as you say, in a normal market. And we will just leave aside trying to define a normal market. But through the fullness of time, I gather, when I listen to you, and I have for years, you know, you're going to be moving in and out of the market. Lately, you've been rather out. You've been a little more defensive than you would be. Before we took the break, I asked you what would cause you to become more fully invested, or maybe up to the kind of benchmarks that you would have. And I realize that's a tough question to answer. I'm not trying to trip you up, but for the folks that are listening, maybe the way they want to hear it is, you know, is when should I maybe be thinking in terms of putting some more money in the market? Is there something that I should be looking at in terms of they ring a bell and say, okay, it's time to go back in? Or I think with your strategy, your approach, it's a little different than that.
It is, and one of the things we always look for, especially for the person who's got the capital preservation mentality, is to look at confidence. Is there confidence in the market? Mm-hmm. If you've got some confidence in the market, then you can probably step in and buy a few things with some relatively stable situation. But if you don't have the confidence, markets are going to bounce around like they are right now. So that kind of a person is probably going to stay away until he or she sees some uptrend that looks like it's going to stick around for more than a day or two. Mm-hmm. The other person who's got, say, 50, 60% or so in the markets, he or she can take a little more aggressive stance in the markets. They're looking for that value to be upsized over time. Maybe they can take a little more of a position, regardless of whether or not you have confidence, because the best money in the market is made when you step right up when nobody else wants to buy. And maybe we're coming into that situation right now. If we look at these markets, and they've been terrible over the last while, mm-hmm. I mean, how much more will they go down? I don't know the answer, but maybe the answer is a fair amount from now. If that's the case, and you step in and then you hold for a while, and every so often look at what you've got and say to yourself, should I still have what I've got? If the answer keeps coming back yes, then stay with whatever plan you have. And over time, things will get better, because usually confidence comes back. We've had a lot of bad markets over the last 50 years. They've all come back. Hopefully this one will also come back, but it may take longer than some of the other ones we've had.
Something that Adrian said earlier, and I thought was very important, is it's not all or nothing. And I know the way you approach the market, you're not like putting all your money on one stock. You're more broadly diversified in the market. Tell me about that.
we want to be very diversified in the markets. So let's say that you have some stocks or some equities in Canada. You want to have at least 60 companies in Canada. If you're in the US, you want to have at least 500 companies, which is the S&P 500. If you're outside of North America, you want to have another 200 or 300 companies. So that's a very broad portfolio. And I know that some of those companies are not going to deliver. I just don't know which ones they are. So I don't fuss about, which one it is that is not going to deliver. But I know that I'm going to be right more times than not. So if I can be right 6 or 7 times out of 10, I'm doing relatively well as a portfolio manager. So that's the key for somebody being in this thing for the long term.
So instead of buying one stock, it sounds to me, and nobody's going to go up and buy 500 individual. Well, maybe somebody would, but the way to do that is with some kind of a basket or an index or something like that.
We're essentially a passive kind of portfolio management firm. We use index funds and exchange-traded funds, so we buy baskets. When we're buying Canada, we're buying a basket. We're never buying one stock. We're never buying any of that. But we are buying a basket of various stocks, be it the top companies, and we always try and stick with quality. So we look at quality first. We look at a basket of something in whatever market we're trying to populate the investment with, and I think that's it's not foolproof. It doesn't mean that you're not going to have difficulties every now and then. It doesn't mean you're not going to incur losses, but you're going to be right more times than not.
Adrian, thanks for that. We're going to take a quick break, and we'll be back with a little more of Adrian Mastracci, Portfolio Manager at KCM Wealth Management in Vancouver. We'll be right back after this break.
You're watching The Money and Wealth Show.
American Manganese Inc. has a manganese deposit in Arizona, indicated 6.7 billion pounds, inferred 8.9 billion pounds, potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
The Money and Wealth Show is archived online at TalkDigitalNetwork.com. Here's Victor Adair.
Well, welcome back. We've been talking with Adrian Mastracci, Portfolio Manager in Vancouver with KCM Wealth Management. Adrian, you've made the point that for your clients, regardless of what stripe they are, that you've been more defensive than usual given the market conditions. We haven't got all day, but you've got a few seconds here. Is there one thought that you'd like to leave in our viewers' minds before we say goodbye?
Patience, patience, patience. You've got to have lots of that in order to look at your portfolio and say to yourself, where do I want to be in 5 or 10 years? That's the key.
Thanks for being on the show with us today.
You're very welcome.
Certainly appreciate it. I also want to say thanks to Fritz at Churchill's Licensed Lounge at the Holiday Inn and Suites in North Vancouver. He's been a great host for us today. Hope you've enjoyed the show. Thanks for watching.
The Money and Wealth Show has been brought to you by AmericanManganeseInc.com.